Okay, well, I make it just past 2 o'clock, so welcome to our webinar. This, as you can see on the slide, is about the challenges of property tax, and we're joined today by Carl and Nick. So Carl from Sunny Accountants and Nick from Derbyshire Mortgage Services, welcome to you both. Carl and Nick are going to do their presentation shortly, and we will try and make time at the end of the presentation to take any questions that you may have as a result of hearing their presentations. So if you're familiar with Zoom, please look at the toolbar. You'll see the Q&A option. That's your tool for being able to put your questions forward to our panel. Okay, so as I said, our speakers today are Carl Watts and Nick Derbyshire. And at this point, I'm going to hand over to Carl to take it from here, and I'll see you at the end for a Q&A session. So over to you, Carl.
Thank you, Joe, and good afternoon, everybody. The sun is shining, so thanks for spending your, well, for the next hour. It's not going to last more than an hour. Thanks for spending the next hour with me and Nick. So over the last 20 years, the number of people holding properties as an investor or landlord has increased massively. I think there are a number of reasons for this. Pitiful rates of interest on deposit accounts, the exponential growth in house prices, likewise property-based TV shows, which I must confess I watch quite a few of them myself, historically low rates of interest on mortgages, and the unpredictability of investing in the stock market never gets any easier. So this huge increase has led the government to review its approach to property tax to balance the needs of regular property purchasers against investors. So in response to a number of new challenging property tax rules that have been introduced in recent years, which have limited the amount of tax relief available to landlords and investors and led to additional costs, which of course reduces returns. But despite these challenges, property investment still, in most cases, offers a stronger, more stable return than many other forms of investment. But during this presentation, we're going to cover how to get started in the property market, and whether your next property purchase should take place within the structure of a limited company, the difference between property development and property investment, should you incorporate your existing property business, in other words, turn it into a limited company, holding property within a limited company to mitigate inheritance tax, self-employed and mortgages, should you use a mortgage broker, and are they expensive? And finally, we're going to have a look at the 30-day rule on capital gains tax reporting and payments. So getting started in the property market. Property investments become the ambition of many regular working people. And while the days of making the easy money are long gone, so many still believe in bricks and mortar that the market shows no signs of slowing down. The Wealth and Assets Survey, prepared by the Office for National Statistics, has revealed that 49% of non-retired UK adults chose property as the soundest investment choice for maximising finances, which makes it consistently the most popular investment option since 2010. And there are several reasons to consider property investment in the UK. Historically, house prices have continued to rise across the country and look likely to continue to rise given the new rate of home building. It's simply a supply and demand issue. It's always easy to make money in a rising market, and with both house prices and rental yields up in most areas, it's easy to see why so many want to enter the property market. Property investment is also easier in most cases to comprehend and manage when compared to more complex forms of investment, such as stocks and shares, which also tend to be more volatile. Property investors don't need to create anything new or innovate, they just invest in what they already know. And finally, borrowing at the moment is remarkably cheap. So with a relatively small deposit relative to the size of the investment, existing homeowners can enter the market through specialist buy-to-let mortgages. So what's the difference between property development and property investment? Well, the words developer and investor get bandied around a lot in the property market, but they do mean two very different things. However, it can become a grey area. If you're starting out in the property market, here's what you need to know, because it may affect how much tax you pay and the structure of your business. So when a person buys, builds or renovates a property, then rents it out, they're typically referred to as a property investor. And they could operate as a sole trader via a partnership or incorporate their business into a limited company. And in that case, rental income is likely to be subject to income tax if it's not a company, and the investor will be subject to capital gains tax on any gains made following a sale. A property developer instead builds or renovates a property and then sells it. There was never really an intention to rent the property. Any profit on the sale of the house in that case will be subject to income tax and national insurance if self-employed, or corporation tax if the person operates via a limited company. Of course, the rates are very different on those two scenarios. Of course, in some cases, those lines can remain blurred somewhat, as you may have a property investor that holds property through a limited company in portfolio, but who also regularly builds and sells property. However, it is important that those entering the market understand this distinction, as it could affect how their business operates, how they are taxed, and may even affect registration requirements for other things such as VAT or the construction industry scheme. So looking at the benefits of holding portfolios within a limited company. So when you first start in property investment or become a landlord, it's often not very clear what the benefits of holding property in a limited company may be. For one thing, setting up a company comes with certain obligations, such as annual company's house filings, appointing a director, and that can seem daunting at first. And what about arranging mortgages? How easy will that be within a limited company? Will they cost more? We will look at that a little bit later with Nick, actually. In fact, for many years, most landlords saw little or no benefit of holding their portfolio within a limited company, and much preferred to operate as an individual. This meant reporting their rental income on the property pages of their personal tax return and avoided all the hassles of running a limited company. However, changes to the tax rules, particularly for buy-to-let properties, means that there may, in some cases, be an incentive for landlords and investors to incorporate. So the changes have been phased in gradually since 2017. But since April 2020, landlords can no longer deduct the interest charges on their mortgages or any other finance against their rental profits in the same way as they're able to offset repair costs, for example. The specific rules are more complicated than they first appear, but on the whole, this change has had a devastating effect on landlords with a large portfolio. I'm talking rental income alone, £75,000 plus, and higher rate taxpayers. So it's important to point out that these changes often have no effect on a basic rate taxpayer, owning just a handful of properties, but there are exceptions to that. In comparison, properties held within a limited company continue to have all loan and interest costs offset against profits as before. It's also worth mentioning that if you are a higher rate or an additional rate taxpayer operating a property portfolio through a limited company, the company's profits are taxed at a flat rate of 19% corporation tax, possibly rising from 2023. Rather than being taxed against personal income. And this fact becomes important if you do not intend to take an income from your property portfolio. You'll suffer double taxation if that's not the case. The company will be taxed on its profits, and then you'll be taxed personally on the withdrawals, whether that's via a pay-as-you-earn scheme or by dividend. But again, I will offer a disclaimer. There's often a large director's loan account balance owing to the director within a limited company, normally as a result of when they've incorporated, they've either introduced cash or an asset. Making withdrawals from a director's loan account will not suffer any tax. If you don't need an income from your portfolio and you're more concerned with capital growth, why not invest the surplus profits into a pension? You will need an FCA registered financial advisor for pensions advice, but we can certainly make recommendations on that. So looking at incorporating an existing property business there. These are properties that you're already holding personally that you're thinking, perhaps I should put those into a limited company. So having learned about the benefits of incorporation, many existing landlords with buy-to-let mortgages may be encouraged to incorporate their existing property portfolio as well. But this is not a decision you should take lightly. There are a couple of ways in which the taxman can get you, and professional advice from an advisor experienced in this field is vital. The first one's capital gains tax. So the transfer of the portfolio into a company would prima facie be a transfer for tax purposes at market value, with a resulting capital gain on the transferor in respect of any assets standing to gain, which is basically going to be what the market value is when you move them, offset against what you paid for them originally. However, there is a tax relief known as incorporation relief that can postpone that capital gain until such a time as the properties are disposed of once inside the limited company. Of course, landlords need to make sure they tick all the right boxes before they can claim incorporation relief. Unfortunately, many landlords fall at the first hurdle. One condition, and there are quite a few, is that they must transfer a business. So what is a business? Well, there's no statutory definition, so I have to look at its ordinary meaning and past tax cases on the subject. Holding a few properties passively, engaging with an agent to look after them while you remain fully employed elsewhere is not likely to qualify as a business. Whereas if you compare that to a landlord spending 20 to 30 hours a week managing the properties, that being their only source of income and in effect their job, and you'll hopefully start to see the difference. It's all about involvement. Ramsey versus HMRC is the definitive tax case on this subject, what they often refer to in any arguments or disputes. And there are many online articles that discuss this in more detail. They actually won the tax case, Ramsey did, and it was all about how involved they were in managing the portfolio that they owned. So it's unlikely to be worth incorporating if you don't qualify for this relief. Probably lots of capital gains there stored up. But again, there are exceptions, and each case is individual and needs professional advice. So if you manage to sidestep the capital gains tax issue, then stamp duty rears its ugly head. I used to think VAT was the most hated tax by our clients, but I'm starting to think it's more stamp duty now. Transferring a property portfolio into a new limited company will incur stamp duty. And again, market values must be used to calculate that stamp duty. I know we're currently in an extended stamp duty holiday, but the additional 3% rate is going to apply at the very least. I would also like to take this opportunity to talk about a couple of tax avoidance strategies that are being bandied around by some firms. The first one revolves around stamp duty and partnerships. Now, there is some legislation that exempts a transaction from stamp duty where the property is being transferred from a partnership into a limited company. And this is creating a market for advisors to recommend that landlords create a brand new partnership, wait around 3 years, and then move those properties into a limited company to avoid the stamp duty. And whilst this is currently perfectly legal, our industry considers this to be tax avoidance. HMRC can and do attack schemes that they consider that have been set up solely to avoid tax. They take the time, could be many years before they take the first taxpayer to court, but if and when they win, they do apply the rules retrospectively. The original advisor is long gone and the taxpayer is left with a hefty tax bill, plus interest, plus penalties. We've seen it happen already with other types of tax avoidance schemes. The second master plan that some firms are touting are like a hybrid tax structure, or known as a mixed partnership. And this has been touted as the answer to the issues that some taxpayers face due to the changes in interest relief. However, with these, there's a danger that the schemes fall foul of some legislation known as the transfers of income streams. And to make matters worse, we do know of some clients that have paid thousands of pounds for this advice just to use this scheme. So to summarise this topic, it's often possible to mitigate the capital gains tax implications of transferring to a new limited company, but avoiding stamp duty is a lot more difficult, full of risks. We've transferred many clients now to a new limited company setup. More often than not, the outcome is capital gains tax, yes, we can avoid, but stamp duty is normally payable. But as always, get in touch if you need advice specific to you. Now I just want to touch on inheritance tax in a limited company. So inheritance tax is often considered to be a tax that only the very rich pay. Unless you're Bruce Forsyth, who reportedly saved around £5 million in inheritance tax by arranging his assets in a certain manner. However, for us mere mortals, we're finding more and more clients are becoming liable for IHT, and the consistent increase in property prices are playing a huge part in this. I don't have enough time today to go into all of the specifics of inheritance tax. That could be a webinar subject all on its own. But I've always felt that inheritance tax is a tax that can be avoided in full with the correct planning. So in terms of rental properties, second homes, etc., many parents will want to pass those assets to the children without paying any tax. And that's easy to do inside a limited company structure. To pass those assets outside of a limited company would involve lots of legal work, lots of legal expenses, capital gains tax, and be a whole lot messier. So by using a limited company, we could start our planning by ensuring that when the property company was first set up, we create a number of shares, probably with different rights to dividends, voting, capital, something like 100 shares in total. Then working with our clients, we arrange for some of those shares to transfer to their adult beneficiaries. So by adopting a drip feed approach, we're reducing our client's estate for inheritance tax purposes, but also avoiding another tax, capital gains tax. And we do that by only transferring enough shares to stay within the nil rate band for capital gains tax, which is currently 12,300. We do all the paperwork at our offices. There's no need for any legal work because the properties stay within the ownership of the company. The legal owners of the properties remains unchanged. It's just the shareholdings that change. And if we start this early enough, we can ensure that the whole portfolio shifts out of our client's estate as they get older. But importantly, due to some clever work with the shares, we can ensure that they can continue to take an income from the company if they need one, as well as keeping control of the company through their directorship, you can say director, and the type of shares. So that's two taxes nicely avoided, and it's all perfectly acceptable as a form of inheritance tax planning. Moving on to disposing of a portfolio, the 30-day rule on capital gains tax reporting and payments. Now, this came in April 2020, but we're still coming across lots of people that have got no idea that it's actually a new rule that's in place. So since April 2020, the date on which capital gains tax must be paid on gains arising on the sale of residential property has changed. Taxpayers now only have 30 days to file a capital gains tax return, which is something new, and make an advance payment towards their tax bill where capital gains tax is due. So I'll say now that reporting the gains is not easy. It's very fiddly, involves a lot of to and fro in between us as the advisor and the client. 30 days is not a lot of time to get your paperwork in order. Arrange a meeting with your advisor, give them time to do their bit, and for you to pay the taxes due. And for that reason, I advise all relevant property owners to get the government gateway account set up now, which will save time as and when you need to use this new regime. We can't do our bit without the client having their own government gateway account. So the way it works is that we would complete like a mini tax return for the capital gains. But to do that, we also need to know about what other income the property owner has or will have in that tax year. This is so we can use the correct rates of tax. The figures will then be repeated on your personal tax return if you normally complete one, giving credit, of course, to the tax that you've already paid. And any over or underpayment will be offset, as you would imagine. So most people are aware that they're not going to pay capital gains tax on their own home. There are some exceptions, but they are fairly rare. Unfortunately, landlords, second homeowners or investors are not so lucky, and they must comply with the new 30-day rule. It's also important to note that non-UK residents will need to report property disposals within 30 days, even if no tax is due. And the residence was the main home when they lived in the UK. So as always with HMRC, penalties for late filing. So if a return is not filed within 30 days of the completion date, an automatic late filing penalty of £100 will apply. If the return is more than 3 months late, daily penalties can apply. And then fixed penalties, £300 of 6 months and 9 months. Underpayments and late payments of notional CGT will attract interest. Interest will be charged on capital gains tax, which is not paid within the 30-day deadline. I've not seen any penalties or interest yet, but we expect to. Are there any exemptions? So where the gains fully covered by a capital gains tax relief, brought forward losses or the annual exemption amount, there's no requirement to file a capital gains tax or paying a capital gains tax on account. If the disposal of residential property also results in a capital loss, you don't need to report it to HMRC within 30 days of completion. There's no gain to report. And at this moment, I would now like to hand over to Nick Derbyshire, who's going to talk to you about mortgages.
Good afternoon, and thank you very much to Carl for the opportunity to speak on this webinar. So, Joe, can I just have the next slide, please? So, just want to go through what I'd like to talk to you with about today. So, why use a mortgage broker? Top tips before making a mortgage application: mortgaging an investment property, having a relationship with an accountant, and a bit about Derbyshire Mortgage Services. And next slide, please, Jay. So, why use a mortgage broker? Independent and whole of the market. So mortgage brokers have access to a large network of lenders, ensuring we get the best possible terms, rates, and products for our clients. Everyone's mortgage requirements are different. We will find the best deal that suits your needs. Affordability calculations. So we can work out how much you can borrow with different lenders. We have the tools to work this out quickly and efficiently. And this is especially important for self-employed clients, as lenders will be looking at potentially net profits. If you're a limited company director, salary and dividends, companies with retained profit. So again, give you a real accurate indication on what kind of loan you can apply for with the lender. Experts in our field. So we provide guidance and advice on mortgage products, current market conditions and interest rates, and we're registered financial advisors. Brokers only sell mortgages and related products, and as advising on mortgages and options every day, we're aware of all the potential pitfalls and hazards with the lenders. Understanding the lender's policy and criteria. Every lender will look at the same application differently, and a good broker with experience and knowledge can match your individual circumstances with the right lender first time. There's a wealth of jargon out there, and a broker will decipher this and explain this to you. Save you time and stress. Time is precious, and shopping around for a mortgage can be both time consuming and frustrating. A broker will save you time, save you stress, and find the best deals on the market. Submitting applications, liaising with the lender, and then taking the application through to offer and completion. Considers your credit scoring. So shopping around for the best deals and products on your own can have a negative impact on your credit scoring. Too many inquiries can cause your credit score to decrease, which can hinder a mortgage application. Many lenders' systems perceive multiple credit searches as a sign that you're being rejected. So again, a mortgage broker will help eliminate this risk and preserve your credit rating. They will have identified the right lender for your mortgage needs. Offering a mobile service, unlike a bank, which requires appointments and restricted to days and times, a broker can fit in with times and days that suit your needs. Visit to your homes, visits to your businesses are undertaken, and again, this saves you time and stress. Providing ongoing support and consultation, broker will review your circumstances on a regular basis and also negotiate with lenders directly when your current fixed rate is coming up for expiry. Gone are the days where you stay and stick with the same lender. Your life's changed and potentially your mortgage provider will. A Derbyshire mortgage services broker charges no fee. Why pay a fee when we're free? Every mortgage broker receives a procuration fee from the lender if a loan completes. Many other brokers will charge a fee on top of this, usually between £199 to £500 for the advice, administration and the processing. At Derbyshire Mortgage Services, we'll never charge you a fee at any point. Why? We want to build a lasting relationship with you. And as a primarily a referral business, doing a great job for our clients, we want you to tell your friends, relatives and colleagues. Joe, can I have the next slide, please? So, top tips before making an application. What can you do to be in a position where you will hopefully have an easy process and a successful application? It's all in the planning before you start looking at mortgage applications. So first off, are you on the electoral roll? When a lender does their credit checks, they want to be able to find you. So it really is key making sure you're registered at your address. Check your credit file before the lender does. We're seeing a large increase in clients who have got historic missed and late payments that they're unaware of. This is usually a communications bill. So before you start looking at a mortgage application, check your credit file. And if there are any errors being registered, now's the time to go back to those providers and have these incorrect credit entries corrected. Pay your bills on time. Again, missed bills certainly prior to a mortgage application will have a detrimental effect. Try and stay out your overdraft. Sending bank statements in where clients are consistently in an overdraft can be a sign for the lender that you're living beyond your means. So if possible, get that bank balance positive. The real key for an application is having your paperwork prepared, in order and organised. Lenders these days, when we upload documentation, there's a wealth that they need. So potentially we're going to be uploading bank statements, pay slips for the employed, P60s. If you're self-employed, tax calculations and overviews. Ensure that your identification and your proof of address is where you're living now. Proof of deposit. Again, this at the moment is real key to lenders. So they like to see a build-up of funds. Finally, consider using a mortgage broker for the reasons that we went through earlier. Can I have the next slide, please, Joe? So, investment property. So we have residential mortgages and buy-to-let mortgages. Primarily, what is a buy-to-let mortgage? Well, buy-to-let mortgages are specifically for properties that landlords rent out to their tenants, where a regular residential mortgage are specifically for properties that the homeowner occupies. Next slide, please, Gina. On a buy-to-let mortgage, most landlords will choose an interest-only mortgage. This is where monthly repayments are made up only of interest on the amount borrowed. The amount borrowed will always remain the same at the end of the mortgage term. So, for example, if you borrowed £75,000 on a 25-year term on interest only, at the end of that 25 years, £75,000 is outstanding. The interest-only mortgage can give you more flexibilities as the monthly payments are lower. Next slide, please, Joe. So, starting to look at the cost of an investment property. So, you would need a larger deposit than a residential purchase, on average a 25% deposit. So again, on a £100,000 purchase, a £25,000 deposit, and then the mortgage loan would be £75,000. Next slide, please, Joe. So calculating the affordability on a buy-to-let property is different to the residential. It's not so much about your personal income, it's about the rental yields that the property achieved. So the borrowing amount calculated on the income the property will generate. A common calculation is that the monthly rental income must be 145% equal to or more than monthly interest only mortgage payments at a 5.5% reversionary interest rate. So for example, if you're borrowing 75,000, this would mean that the rental income the property must yield each month is £498 to cover the mortgage payments of £261. Next slide, please, Jane. Again, the costs are more than a residential mortgage. Your interest rate's going to be higher, and potentially there are going to be product and arrangement fees with the loan. And as Carl was mentioning earlier, with second properties, you will be liable for stamp duty on the properties. So for the first 125,000, there would be a 3% charge of stamp duty. Thanks, Joe. Next slide, please. So as well as buy-to-let mortgages, as Carl was saying earlier, there's also limited company buy-to-let mortgages. So what are the main differences between them? A regular buy-to-let mortgage is owned and purchased in your name, and you then become a private landlord. A limited company buy-to-let mortgage is exactly the same, except you're purchasing it through a limited company or SPV, which is a special purchase vehicle. Buying in a limited company can be more tax efficient than doing so as a private landlord. Next slide, please, Jay. So just to give you an example of the different costs between a standard buy-to-let purchase and a limited company buy-to-let purchase. And again, I've based these figures on a purchase price of 100,000 and borrowing 75,000 for the mortgage. So the top lines there, we've got a slight difference in interest rate. So your standard buy-to-let is 2.34% and the limited company buy-to-let 2.79%. If you looked at a 2-year deal on interest only, monthly mortgage payments for the standard buy-to-let, £261 per month, and on the limited company buy-to-let, £284. Extra fees. So with the standard buy-to-let purchase, there's no product fee and there's no valuation fee, stamp duty liability of £3,000. On the buy-to-let limited purchase, then product fee of £1,125 and a valuation fee £370. So the starting point with this one is £1,495 to set up for the limited company buy-to-let. If you actually look at the payments over the 2 years, there's an extra £552 of mortgage payments over that time. And again, these figures are based on what we would call the true cost over a 2-year fixed rate period. So these are the cheapest deals on the market today. Next slide, please, Jeff. So as a conclusion, a limited company buy-to-let mortgage does cost more. However, in the long run, it may be better to buy a property in a limited company, have that set up. But this is the time to sit down with an accountant or independent financial advisor to see which is the right route for you. At this point, I just want to talk to you about having a relationship with an accountant, especially for mortgages. So before you reconcile your end of year accounts, it's always great to have a meeting with your accountant, because for mortgages, the lenders are always going to look at your net profits, your salary and dividends, potentially your retained profit. So before you think about applying for a mortgage, liaise with your accountant to see what the figures are going to end up at. And again, that's a good time to get in touch with a mortgage broker, because I will quite often receive a call from self-employed clients and they say to me, this is going to be my salary and dividends for this year. And I can confidently say at that point whether that's going to be enough to be able to attain the mortgage loan that they need. Accountants are quite often asked to provide accountant certificates for the lenders. And again, a good accountant with some great explanations, sometimes for large increases in profit or even decreases, can really make a difference when that is placed in front of an underwriter, a lender, and determine whether you will get the loan or not. And there's a quick example. I've worked with Carl for 5 years now, since setting up my company. And 3 years ago, I needed to be in a certain position for a remortgage. And again, working with Carl before, knowing exactly what figures I needed to attain the mortgage I wanted, then I had a successful outcome. And again, just before Christmas, a meeting with Carl, again, because of some home improvements I'm looking at, I need a certain amount for a remortgage. We've already worked on those figures together, and hopefully another smooth process. So absolute encouragement to have a relationship with your accountant and regular meetings and communication. Next slide, please, Joe. So just a little about Derbyshire Mortgage Services. So we're local. We're proud of our Derbyshire roots and love speaking to our customers face to face. We've got plenty of friendly advisors and we're always waiting here with the kettle on. We're flexible, on the phone, online, in your office, at our office, in your lunch hour or in the evening. Our services are flexible to fit in with your life. Bespoke. Every person and every home is different. One mortgage certainly does not fit all. Whatever your situation, we'll find the best deal for your needs. No fee. There's no catch. We are fee free. We never charge you a mortgage broker fee, and we always offer free mortgage advice. So why not give us a call today? Next slide, please, Joe. Joe, I don't know if you click on the middle, there is a short video, just no. Thanks very much, everyone, for your time.
Okay, well, thanks very much, Nick, and thanks very much, Carl, for the presentation. I do have a couple of questions here, just in the last few minutes that we've got left. I think this one's more for you, Carl. Somebody here, I'm in the fortunate position of being able to pay off some of their mortgage. Should I pay off the mortgage in the house they live in, one of the rentals, or are they better off using the money elsewhere?
We get asked this question a lot actually, Joe, and the general advice around that one is to pay off some of the mortgage in the house that you're living in. Now, the reason that we normally say that is because the mortgages on the buy-to-let rental properties, that's generating some interest presumably, and that interest will be offsettable against the rental income, whereas the interest on the residential property, you can't offset that against anything. And the second part of the question regarding using the money elsewhere, I always say, well, what else are you going to do with that money? If you're going to keep it in the bank, you're going to get an interest rate that's very, very low. Now, you could invest in the stock market, you could buy some Bitcoin, but that's a whole different ballgame. There's a lot of risk there. So then it becomes a case of, well, what's your attitude to risk? The safer option is pay off some of the mortgage. Yes, the rates on mortgages are pretty low, but you're not going to be able to get that rate anywhere else without taking some type of risk.
Okay, thank you. This one's for you, Nick. If you're self-employed, how many years accounts do you need to have to be able to apply for a mortgage?
Okay, so a lender will always prefer a proven track record. So ideally, it would be 2 years worth of accounts. However, 1 year, there's lenders out there who will look at that. But the choice narrows down the less years of accounts you've got. So I guess to answer the question, 1 year's minimum.
Okay. And a final one we've got time for you, Carl. I just put a new kitchen into one of my rental properties. Can I offset the rental income, or is that classed as a capital expenditure?
Well, if it's a like-for-like replacement, so you've ripped the old kitchen out, you've replaced it with a brand new one of a similar quality and a similar standard, then that will be classed as a repairs and renewals, and then you will be able to offset it against rental income. The confusion comes in sometimes where somebody's replacing an old kitchen for something that's a dramatic improvement on the one before. In other words, they've enhanced it, they've improved the building. That's when it starts to become a capital item. But most of the time in rentals, you're just going to put a like-for-like replacement in, but a more modern one. So then that would be allowable, yes, against rental income.
Okay. And one question here about owning two properties. So if you own a property but you don't rent it out, and you live in a property, when you sell the property you live in, can you move into the second property without incurring any kind of capital gains tax?
Yeah, I think I know what this question's aimed at. It's the default position. If you sell any properties, there's going to be a capital gains tax bill on the sale price versus the purchase price. The usual exemption is around the main residence relief. Now, whether you're going to qualify for that, it depends on the facts of the case in each situation. So if you've moved into that house and perhaps changed your address with the council on your driving license, and it looks like a permanent thing, then HMRC will look upon that as, yes, that's now your address, and then you'll be able to claim some of the main residence relief against the gain, yes. So there's no minimum. People ask me a lot, is there a minimum time period that I need to move into it? No, there isn't. You could be there a month, as long as you've done the right things. Time is irrelevant to it, to be honest.
Okay. All right, well, look, that brings us to the end of our webinar right on time. Thanks very much for your presentations. We will make a recording of this webinar available on the website later on today for those of you who've attended and want to recap on anything. And it just remains for me to say thank you to Carl and Nick. Thank you.
Thank you.
Thank you, everyone.